Let's dive right into this. We are witnessing a monumental, frankly unprecedented shift in the global financial architecture. For decades, you had traditional finance in one corner and digital assets in a completely separate universe. Well, that era? It's officially over. Today, we're looking at a massive structural embrace of blockchain technology by the exact same institutions that used to view it with total skepticism. Institutional fusion is here, it is accelerating, and we're going to unpack exactly how legacy banking is migrating on-chain. To understand the sheer magnitude of this shift, here is our roadmap for today's explainer. First, the evolution of banking. Second, the regulatory green light. Third, the stablecoin volume boom. And finally, Wall Street goes on-chain. Section 1. The evolution of banking, from telephones to tokens. It is absolutely crucial to understand that blockchain is not some sudden isolated fad. Not at all. It's the highly anticipated next step in a long, continuous history of financial upgrades. I mean, the banking sector has always had to evolve to survive, right? Rewind to the 1980s, and the absolute cutting edge of finance was telephone banking. Then the 1990s brought the e-commerce boom and internet banking, which completely changed how we access our money. The 2000s literally put the bank in our pockets with mobile apps, and the 2010s optimized the back end with machine learning and AI. So now, here we are in 2025, and blockchain and digital assets are simply taking their rightful place on this continuum. This integration isn't a disruption, it is an evolution. Tangible assets are seamlessly morphing into digital code because the technology is finally matured enough to meet the exacting demands of global finance. Moving to Section 2, the regulatory green light, securing the framework. Look, superior technology alone just isn't enough to move trillions of dollars in institutional capital. You absolutely need strict compliance for that. Global regulation is the necessary guardrail, unlocking this adoption, and we are seeing incredible global coordination right now across major financial hubs. Over in the US, the FDIC and SEC are issuing direct guidance for banks engaging with digital assets. In the European Union, the Markets and Crypto Assets Regulation, MiCA, is being actively enforced by national competent authorities alongside the ESMA and EBA. Meanwhile, in Dubai, the Virtual Assets Regulatory Authority has laid down very clear guidelines, and in Singapore, the Monetary Authority is taking decisive actions of their own. All these international agencies are waking up to the need for regulatory clarity. They're taking deliberate, coordinated action to reduce that ambiguity, protect consumers, and really support responsible innovation. So the crucial takeaway here is that legislation is paving the way. And honestly, nowhere is this more evident than with the Genius Act, passed by the U.S. Senate on June 17, 2025. This legislation establishes clear, robust federal oversight for stablecoins. This is a monumental legislative milestone. It essentially signals to the traditional market that, hey, digital assets are now a recognized, regulated part of the modern financial system. It gives those legacy players the definitive green light to step in and innovate responsibly and securely. That brings us to Section 3, the stablecoin volume boom, data in motion. Because those regulatory guardrails are now firmly in place, capital is flowing at breathtaking speed, $650 to $700 billion. Let me be incredibly clear about this. This jaw-dropping figure represents the monthly stablecoin transaction volume during just the first quarter of 2025. We are not talking about annual volume here. We are talking about hundreds of billions of dollars moving across digital rails every single month. This data completely, undeniably validates the immense scale of institutional demand for digital assets right now. So you might be wondering, why are we seeing over $500 billion a month? Well, it really comes down to undeniable efficiency gains that are driving this massive adoption. The legacy systems simply cannot compete with these core benefits. Blockchain technology allows for significantly faster transactions, true borderless global access, incredibly low cost compared to traditional wire transfers, and crucially, 24/7 availability. Markets that never sleep require infrastructure that never sleeps. As these efficiencies are realized across traditional finance, the benefits of integrating blockchain have just become impossible to ignore. And finally, Section 4, Wall Street goes on-chain, real-world integration. This is where the rubber meets the road, and we actually see legacy banks actively deploying capital. It's not just theory anymore. Institutions are directly responding to a massive surge in client demand for digital asset exposure by launching and offering access to crypto exchange-traded products, or ETPs. This rising client demand has practically forced the hands of traditional institutions. They literally have to offer direct crypto exposure because their clients are demanding it, and the institutions must adapt if they want to retain their massive pools of capital. But the integration goes far deeper than just offering ETPs. When you compare traditional legacy settlement to the new tokenized model, the contrast is stunning. Just look at this concrete case study. JP Morgan Chase recently completed its first public blockchain transaction. They actually settled tokenized U.S. treasuries on a public blockchain, partnering directly with crypto-native businesses like Chainlink and Ondo Finance to execute the trade. Legacy banks aren't just building private walled-off gardens anymore. They are actively utilizing public crypto infrastructure to tokenize real-world financial assets. It's a total game changer. Which brings us to a rather stark realization regarding the entire industry. Now we're entering into a new era of survival of the fittest. Really think about the immense gravity of that statement. The stakes for traditional banks have literally never been higher. The rapid proliferation of blockchain technology has spurred entirely new business models for fintechs, allowing them to carve out their own massive share of the financial services pie. If legacy institutions do not adapt and evolve, they risk total obsolescence.
So, I'll leave you with this final critical question to consider as you digest today's explainer. With growing institutional demand for digital asset services and the rapid tokenization of real-world financial assets, will traditional banks adapt fast enough to maintain their place at the top of the finance food chain? Or will a new breed of fully on-chain institutions take the crown? The technological upgrade is already here. The only question left is who is going to capitalize on it. Thank you so much for joining me for this analysis.